Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, who has taken time out of her very valuable vacation space to talk to us. She's the editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Happy New Year, Danielle, and welcome back to the show.
Hey, thanks, Jim. Actually, I'm not on vacation. I'm back at work. I'm just working. I'm traveling and working at the moment, but I am back at work full.
Oh, I was going to say a semi-vacation then, or because you're traveling, it doesn't seem like work?
Well, you know, I don't complain. It's all good. My work follows me everywhere I go on the planet. That's fine.
You can't get away from it.
No.
Danielle, oil prices now, they're starting to tickle $65 US a barrel. Some people have said it's because the Arabs and the Russians have been able to maintain their production freeze. You have a different theory behind why oil prices have been climbing.
Well, I think, you know, there's definitely a big incentive to trade this commodity, and we have record amounts of speculators going long right now. We have, HFT and all the usual suspects in there wailing away looking for, different ways to make easy profits or skim money off of different trades. But in the end, I think the main, there's a technical rebound. The price has been recovering over the last couple of years, but when you look at the big picture, so to speak, you see that, in fact, there's a lot of incentive short term to try and get prices higher, both because, the Saudis have said that they have, cash flow needs. They need to get the price around 60. That was their target. Great, they've achieved that. But at the same time, they don't want prices to be much higher than that because of the incredible impetus that gives to other producers to turn on the taps, so to speak. But at the end of the day, I think one of the largest incentives right now is this Aramco IPO. It's been sort of dangled in front of the market participants for the last couple of years. They've been talking about selling off 5%, and of course that could be 1.5 to 2 trillion depending market value, depending on where the price of oil is. And now we've got all these negotiations going on about which investment banks are going to be getting a chunk of that underwriting fee, which on a couple of $1 trillion, Jim, that is big money. And these are the same firms that employ all the traders that can go in and manipulate and maneuver the price, as they've done many times before, front running the trade, so to speak. So I think that's one of the main factors. I think we've got a technical rebound. I think we've got all this positioning for this IPO. But at the end of the day, the problem that everyone faces longer term, as an investment in this sector right now, is that the advantages of the technological improvements, the, production that's come on stream and continues to accelerate, frankly, because of technological improvements, is mind-boggling. Like, we're talking about, a 50% jump in the ability to take oil out of certain wells without drilling any more holes. So we don't need to have rig counts increase anymore. They can literally just increase production by a factor of, 50% more in many cases than they could 2 years ago, just from the same holes, so to speak. So that all is incredibly that means that supply is incredibly fluid, and as soon as price ramps, you have this incentive to produce more. And of course, there's that technology is all over the world. So it's no longer just a couple of pockets of big production in the world. It's available all over the place at the same time that you have this ongoing shift to different alternative fuels and greater efficiency, which is, something that is not going away. And just because we have a government in the U.S. that is not friendly to the idea of alternative energy does not mean that this trend is in reverse anytime soon. In fact, I would suggest to you that it is actually given sort of a bump or an incentive to people. And the higher the price of oil goes, the more that's likely to be the case. So the more there is margin, if you will, to encourage other production and other fuel sources. So it's really this perfect circle of, high prices are the goal of the producers, but at the same time, higher prices mean more incentives for more supply and other alternatives and higher efficiency, and thus lower prices.
I've also been told it's because of the increased demand from China, where the last time I heard, and this might be an old statistic, they're selling 50,000 cars a day. Well,
it's interesting, right? If you look at what's going on in China right now, they have definitely been slowing in terms of demand and growth and consumption for the last couple of years. And in fact, we're seeing them need cash as opposed to, coming out of the last bottom, so to speak, in 2009, China led the way in terms of infrastructure spending and stockpiling of commodities and, bringing in all sorts of products when prices were relatively lower as part of this effort to re-stimulate the developing world, so to speak. So they were one of the leading forces, both through their central bank but also through just fiscal spending. And so what happened was they took on enormous amounts of debt. Same old theme that we've seen many places. They took on enormous amounts of debt to get that spending up front. Now what's happened is they're in a bit of a cash crunch at home. And what we're noticing is they're preferring, instead of just pounding money into hard assets or anything collectible, they're actually needing to raise cash. And their banking system is so over-levered and indebted that they literally have a liquidity crunch. So they're starting to sell things. There was much talk this week about whether they were going to, liquidate a good amount of their U.S. Treasury holdings. And these are the old assets that they accumulated in the spending binge that went on leading up to the 2008 crisis, right? America was spending consumer goods like never before, and that money was recycling over to China, who was providing a lot of the goods, and they were then in turn putting that back into U.S. Treasuries, which helped keep rates low and helped the whole gig keep going for a while. But now we're seeing that they are in a bit of a credit crunch themselves, and so their preferences, and it is for everyone, whether it's a family, a business, a country, at some point when you've got so much debt, you now have to be concerned about cash flow. And I think China's there right now. So yes, they have a demographic story, but by the way, that's in decline because of their population getting older and their low birth rates. But you're seeing that they are definitely having a preference for how do we raise actual cash here. And that's really a game changer, because in this whole sort of gig we've had since the last recession, it's all about who can get free money to buy more assets, to put prices up, to put on more debt, to lever that further. And we've seen that in every walk of life, in every country, and in every asset class. And indeed, we were talking before the show about, Canadians again levering their house, whether it's be on Helcos or reverse mortgages, anything at all to extract that increase in the value of their property out for cash they need to spend. And that's happening in the U.S. as well. I put an article on this week about how, the savings rate in the U.S. is now back below where it was in 2007, right before the credit crisis burst open, Jim. It's less than 3%. The long-term average savings rate in the U.S. is about 8.5%. So we're now something like 2.9, and the same in Canada. This is a phenomenon we've seen all over the world, so also in the UK. So all these economies that, in the Eurozone as well, all these economies that are the biggest drivers of the world in terms of consumption and growth, are in this not only demographically unfavorable position of having an older population that consumes less, but we've got now, again, back to little savings, lots of leverage, lots of debt. And that's why I am not that optimistic about all these people that talk about we're going to get fast growth rebound in 2018, and we're going to have lots of rate raises from central banks, and that's going to, cause a bunch of problems in the government bond markets and all that. I don't buy that, because what I know is that the more debt you add to a system, the slower the growth. And the slower the growth, the less room there is to raise rates. And, you're seeing that, with the Trump tax cut package. Everyone's, salivating about, won't this mean great stimulus? Well, the fact of the matter is it's an unfunded tax cut, meaning they haven't yet figured out where that's going to be paid for. They haven't cut spending to offset that drop in revenue. So that just means they're piling on more debt. And again, adding more debt just long-term slows the money velocity through the economy, slows the consumption ability, and means you're at lower for longer. So the same thing, for example, in Canada. Even if we don't get a burst, so to speak, in these incredibly high asset prices we have, or real estate prices that we have, a lot of the economic study and think tank groups are pointing out that Canada's in for a very tough slog here. We have had a relatively privileged or advantaged growth rate over the past 15 years, but looking forward, the Bank of Canada and all various different forecasting groups are saying, hey, you could see a 50% fall in the GDP growth rate in countries like Canada over the next 12 years. So we're not talking about for a couple of months. We're talking about a sustained trend, equal and opposite in the other direction, which means we could have half the growth we're expecting, and we're already stuck with all these debt payments. So consumer spending is likely to weaken here, even if rates don't go higher and even if asset prices don't burst. All they have to do is stop going up, and suddenly this ability to, refi your house and scoop out the equity, which is a very self-destructive habit. It's what brought about the U.S. housing crisis in 2006-07. Canada's been doing it with a vengeance. So, we just need to have a decline in residential housing investment if there's less appetite for new properties to be put in the system. And indeed, this week, Jim, we saw Canadian building permits fall much greater than expected. So I think, we're in for a tough slog in Canada. There's no easy fixes because we've painted ourselves into this corner of too much debt and this slow growth forecast for the next decade at least. And so that means we're going to have to get a lot more efficient and intelligent. So on that point, I thought it was quite interesting that the Canadian government, the Ministry of Natural Resources, yesterday announced they want to do a $120 million investment to expand the network of electric vehicle charging stations. So people will say, oh, well, that's counterintuitive because we sell oil, like oil and gas makes up 18% of Canada's GDP, about 12% of our jobs, and about 27% or so of our exports. So obviously if oil and gas is just in a trade, so to speak, right now, but doesn't face, a big surge in prices sustained over the next several years, then you're going to have, again, pressure there in terms of what are we going to replace it with. So they may feel like, well, we're not going to do ourselves any favors if we put in this coast-to-coast electric charging stations infrastructure, which the government has proposed working on right now. But the reality is that the way to get through this next decade of slower growth and cash crunch and less revenue is to lower costs. So I think it is an intelligent thing, smart investment with lasting benefits. You're going to lower air pollution. You're going to increase the efficiency. You're going to have less costs for households in terms of fuel and in parts and repairs and all that stuff, and will support this migration towards EVs, which will bring back growth to the sector. One of the big risks right now with NAFTA and Trump's talk about NAFTA is how if he pulls out of that deal, they're saying our auto sector is likely to be hit very, very badly. One of the ways we could get some traction there is if Canada, through the auto companies, starts making EV products to supply the world's desire and demand for this new technology. So I think that's all linked to how we get out of this, but it's a long-term investment cycle. It's not a quick trade.
We'll have more with Danielle Park right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Welcome back. We're speaking with Danielle Park. Danielle, in British Columbia, a big debate about the government reapproving the Site C dam project in the Peace River country of northeastern BC. Some people are saying, well, the demand for power hasn't gone up for years because we're becoming more efficient. But as you said, as more electric vehicles hit the road, we're going to have to power them. Is that a good long-term investment if you think electricity is going to be the way to go to move around?
Well, I think we have probably enough hydroelectric power availability and standing water availability right now. If we used all of our sources, we could be much more efficient and probably don't have to make whole new dams. So I think that that's probably, I think one of the big problems with the way we measure economic growth and GDP is that everyone's looking for these big projects, huge investment, create jobs in the short run, right, while we do these mammoth projects. But actually, probably the more efficient way to do this is to tap into existing resources and systems which are already here, or maybe just need some tweaking. So you don't get the big expenditure at the front end, but you get a much more efficient product for the investment. So I'm really skeptical of things like that, huge new dam projects or huge new pipeline projects. I really don't think, even though it might be supportive of GDP in the short run and bring in, business and government spending, the question is that the most efficient way to develop our longer-term economic strength? And I think that the answer is probably no.
Watched a good little feature on business television today about growing meat in a test tube or a petri dish. It's a real animal cell. It's real meat. It'll taste like it, feel like it, and so on. But you won't need an animal to produce it. Is that the wave of the future? You won't need to have big, they say producing meat right now is a very wasteful thing to do. Well,
and I get, a negative feedback from listeners when I talk about this, because I understand many people have had, a lovely life on their land, especially in the Canadian West, for example, whether they be cattlers or farmers, and they have generations. My grandparents were farmers, lived on the land. I got all that. But the fact is, again, I go back to, with 7.5 billion people in the world, on our way to 10 billion, it's not that we can't produce enough food. It's that we have to be smarter and more efficient with the way we produce it. So many people on a sort of a gut reaction are, oh, that sounds disgusting. That's really not the right response. It's just, how do we get the high quality, healthy calories with the least amount of energy and water investment, as well as waste and pollution? And obviously figuring out ways to grow meat cells without sentient beings, without having to go through all the process of the growing, the killing, the cleaning, the cleanup, the disposal of the carcass. All that stuff is very intense in terms of resources and waste. So I think that this is absolutely the way of the future. And it'll help us feed the world. There was an excellent show I caught, I think it was this week, on TVO's The Agenda with Steve Paikin, and he was having, people talk about how can we increase the production of food. And more than that, the answer is how do we waste less? Because some estimate 30% of the food we're producing is being wasted because it's being grown far away from where it's being consumed, because it can't get, passed through or transported in time by its good till date, that because, it goes bad when it's waiting, or because we throw it out because it's, too much is taken here and then there's not enough for people in another location. So obviously, I think going back to the model where we produce food close to population that consumes it is a highly efficient model. And that means that we probably do have a surge in, vertical farming, on-site production, growing in labs, all these really cool ideas. And people will just get over, when a new idea first comes out, it's very common for people to say, oh, that sounds revolting, or that sounds improbable, or that sounds impossible. But that's typically when you're on to something really new and innovative, is when you have that response.
Well, I have no problem with something grown in a Petri dish, because being diabetic, I need a high-protein diet along with fresh veggies and cut out the carbos. So for me, it sounds perfectly fine as long as it's affordable.
Absolutely. And again, it goes back to efficiency and lack of waste. If you're not wasting 30% of your food production because of mismatch between where it's produced or where it's consumed, you're going to have a much more cost-effective food. And I think that's just one of the ways to measure the advantages here. So there's no question in my mind that this is the future. I just know that many people have a hard time adapting to that reality, and they want to think of it as the way we've always done it is the way we should do it, or whatever. But the world has never been static. My son called home from university this week with a great excitement. He'd been to a geology lecture in one of his new classes, and the guy was explaining how the Earth has been this series of phases, and there's been catastrophic events in between each phase that wipe out and start over. And he said, so this really means that this is a phase for humans right now. We're in a phase, and we have to either find a new way to live on another planet, or eventually we're going to be also eradicated, just like every other system or lifespan or time has been on Earth. And that is the truth. So it's evolve or die, and I think we have so much ability, so much creativity that we can employ to solve the problems today. We just have to get on with it.
We'll have more with Danielle Park right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're talking with Danielle Park. Danielle, we hear the NAFTA negotiations are not going well. Several sources now in the Canadian government saying they're not optimistic that it will carry on. They believe Trump is likely going to rip it up. What does that mean to Canada's economic future?
Well, as I alluded to earlier, the biggest risk items are, so we've got this economy that's really dependent on the oil and gas sector, which I already itemized as about 27% of our exports, 18% of our GDP. So there's that piece and how that might be impacted by trade change between us and our biggest trading partner. The other component there is the auto parts, auto manufacturing sector, which again has been huge for Canada in terms of GDP over the past couple of decades. And freight carriers is another area where transports from Canada to our largest trading partner, where again this could have major implications. And I think we should probably be ready for that, because we're dealing with someone who's obviously, dealing with very low favorability in terms of his performance in his first year in office in Washington. And the Trump administration is looking for big ticket deliveries in terms of campaign promises, in terms of big, bold headlines to satisfy the base, and I think that they have every reason in the world to want to put down their foot on this particular topic. Now, the problem the U.S. faces is, as I've said, they've got late cycle now. We're into this expansion, this second longest ever expansion in the history of the economy. Coming into it, the yield curve is very flat right now. The central bank is only at 1.25 to 0.15 as a range of rates. So the U.S. has very little stimulus ability when they start facing a slowdown in this coming period, and that of course will impact Canada as well. So I think even if we get some really draconian, motions or big bold production for the base, so to speak, in the next little while, I think that what we're going to have is this period of slow growth, which may in fact bring in the next recession, which is long overdue, and that's certain to get the attention of everyone back to, oh dear, how do we get trade moving, Now the problem everyone's got is consumption weakness for the reasons I've explained, demographics, too much debt, the preference for efficiency, for spending less and saving more. All that is going to impact slow demand into Canada and the U.S. So I think at some point we're going to want to work together, just as Canada does now, because we are already sort of sweating, looking at our slow growth prospects over the next decade and saying, okay, we got to think fast here. And so we do want to continue trade in whatever way possible, but I think that one of the advantages, I said this when Trump came in and many of my friends were upset with me, but I think it is a shaking up of the status quo. Whether you like him, whether you don't like him, whatever party you feel, at the end of the day, we needed a shake up of the status quo. We cannot continue to have business as usual, old models, old expectations, and old sectors depended on for growth in the bold new future. So I think that all of these deals should be up for revision and up for breaking apart if necessary, rewriting, and that's all probably healthy and required to get to the next growth phase.
Danielle, always fun chatting with you. Thank you so much.
Thank you, Jim. My
guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests like Danielle can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.